Welcome to the Genus video, quarterly video. This is April 2017, and so we're going to talk about the quarter ending March, Wayne. And I just thought I'd sit in the chair of a client for a moment and say to myself, how does Genus handle all the craziness that's happening in the world? And I just made a little list for myself of the things that I think are crazy, but anybody could come up with their own list of things. I've got the the UK election, the French election, which are really important. I got weird weather everywhere. I got Trump antics, I won't go into detail. I got Russia hacking everything. I've got bombing Assad the day after announcing that regime change in Syria wasn't really a priority. And probably the most scary for me is the North Korean situation. So I don't really want to talk about any of those things and the 10 things that are on everybody else's list, but more my question is, how does the Genus investment department digest these things, view these things? Are they noise? When is it material to how you manage the money?
Well, the number one thing we do is, I guess, close the door, turn the TVs off, and look at the numbers and look what's actually driving the markets. And we have macroeconomic models, macro market models that are driven by valuation, growth, inflation, money supply, for example. And we look at what the underlying numbers are saying, are telling us. And that gives us our base case in terms of where we're sitting. And our base case over the past year has been, we're in the late stages of this economic cycle. And within that late stages, typically the more economic sensitive stocks run. And that's been the case over this whole period. And now, when Trump was elected and won, the reflation, there's a lot of talk of reflation coming back and him getting that whole sector, that whole space going again. He helped, I think, accelerate the movement in those stocks, but it really hasn't changed anything. And now that some of the air is coming out of the Trump trade, we're back to the base case, which is we're in the late stages of the economic cycle. And those areas like the financials, industrials, metals will do well. Including technology. And so things really haven't changed. We're with our base case, and then we will adjust that based on what's happening from day to day or hour to hour.
Right, so it's very much, I kind of knew the answer, it's noise and you're focusing on fundamentals. So
well, that's where we start off first, then we adjust that accordingly.
So on the fundamental side, our models for whether we should be in US cash or the world stock market is slightly negative right now, which really is being as a result of monetary policy, the Federal Reserve raising interest rates. Is that a concern to the market? Is that going to slow down the market here?
I don't think it's going to. There's still enough liquidity to push us through this. The rest of the world is they're pushing, the central banks everywhere else are easing as hard as they can. In Europe and Japan, and even in China over the course of the past year, they really goosed things. They've cut it back a bit. But still, the rest of the world is very liquid. The U.S. is tightening up. They're at the front of the train, if you will. So they are tightening things up. So, and usually in the economics of the cycle, at the end of the economic cycle, the markets can keep pace because the growth is fast enough. It rises faster. There's stronger growth in the economy and the markets that will stay ahead of the Fed increase in rates. So even though the Fed's raising interest rates, I think we're still okay here at this point in time. And remember, they brought rates down very, very low. They were below normal. And so I think they're just trying to normalize, if you will. So they're not really that snug yet. But the economy is interest rate insensitive. And so, but I still think we're on for at least two more
quarters.
Two more quarter increases this year. And I think the economy can still do well within that period. I think through the course of this year, it's going to be driven more by what's happening globally. I think the global economy in Europe and in Asia will help somewhat carry the mail this year above and beyond the US, unless we get some sort of crazy event that we worry about.
So Wayne, I get this question often from clients, how do they get a higher interest rate, because it's so frustrating for clients right now, what's available out there in GICs, without taking on market risk. And really I tell clients you can't, this is an environment where really going after extra yield is like picking up pennies in front of a freight train. Can you support me on that, or what do you think?
I agree with that. It's, the fact is quantitative easing globally has really impacted the government bond markets around the world and actually almost ruined them effectively. And our strategy for coming up to 7 years has been to go into the corporate sector, buy corporate spread product, which still is a decent yield and probably better quality than a lot of governments, and also have a dividend strategy focus on. We can still build portfolios with a 4% dividend yield, so that's been our strategy for a long time now. It's still working, we believe,
Right.
is a sort of a portfolio of corporate bonds and dividend strategy stocks.
Right. But if you need the money in the next year, even high dividend stocks probably aren't appropriate because unfortunately
Right.
those good quality stocks will still go down with the market when
Yeah.
the market goes down. But the longer time frames, that's where you want to be. So Wayne, if you were to pick out, 3 or 4 things that you think really important right now, what would you say?
Well, we're still a believer in the reflation trade.
Right.
It's had a bit of a pause. It rallied strong after the election. We've just had a bit of a pause. It's making a bit of a comeback as we speak. We think that's going to probably persist through to the end of the Q3 at least. And very typical of this part of the cycle. Hopefully the Trump administration will cut some taxes and actually add some more wind to this overall trade. But globally, the Europeans, the Japanese, even the Chinese have really pushed a lot of money into the system. And the Europeans, for example, they're beating earnings growth and
Consumer confidence.
and consumer
high.
confidence up. So we expect more push from the global side of the equation this year. And so
And we've upped our European weight.
we've upped our European weight, and we're still focused on the economic sensitive areas, and the reflation trade we're a long-term believer.
So it really, on paper, looked like a pretty boring quarter, at 2.5% for the Canadian stock market, 1.2% in the bond market, pretty good returns for clients, global markets a little better. So there's not really too much to talk about in terms of rates of return. It was a good quarter. So if you have any questions, please call us. We'd love to talk to you, and we'll talk to you next time.